On Monday, silver crashed 8%. Headlines declared the bull market dead. Retail investors across America, Germany, and the United Kingdom watched their portfolios bleed red and reached for the sell button. By Tuesday afternoon, the price had recovered nearly half of those losses in a single trading session. Most people called it volatility. But if you understand how modern markets actually function, you would call it something else entirely. You would call it a harvest. This is not a story about precious metals going up or down. This is a story about how the financial system separates the informed from the uninformed. It is a story about algorithms, liquidity, and the quiet mechanics of wealth transfer that occur in plain sight, yet remain invisible to most participants. And once you see it, you cannot unsee it. The final week of any trading year is unlike any other period in global markets. Wall Street calls it Ghost Week. Trading desks are understaffed. Liquidity thins to a fraction of normal levels. The institutional players who typically provide stability and depth to markets are skiing in Aspen or sailing in the Caribbean. This creates an environment where small amounts of capital can move prices in outsized ways. A sell order that would barely register in October can send shockwaves through markets in late December. The order books become shallow, and shallow water amplifies every wave. On December 29th, silver experienced exactly this phenomenon. The spot price fell from roughly $79 to $71 in a matter of hours. For investors watching in real time, it felt catastrophic. Social media filled with panic. Comment sections turned into support groups. The emotional weight of watching months of gains evaporate in a single session triggered exactly the response it was designed to trigger. But here is what makes this particular episode instructive. By December 30th, silver had clawed back to $74.54. The market recovered $3.35, roughly 5% in a single session. Those who sold at $71 locked in losses. Those who bought at $71 captured one of the most profitable 24-hour windows of the entire year. This pattern has a name. Traders call it a bear trap. It occurs when prices fall sharply through a support level, triggering stop-loss orders and panic selling, only to immediately reverse and climb higher. The trap catches bearish traders on the wrong side of the move. But more importantly, it catches retail investors at their most vulnerable moment, the moment of maximum fear. To understand why this matters, you need to understand who benefits when retail investors sell at the bottom. Modern financial markets operate on a principle that most participants never fully grasp. For every buyer, there must be a seller. For every seller, there must be a buyer. This sounds obvious, but its implications are profound. When a major institution decides to accumulate a position in silver, it needs someone to sell to it. At $80 per ounce, with prices rising and sentiment bullish, nobody wanted to sell. The strong hands, the long-term holders, the industrial hedgers, they were all holding tight. There was no liquidity for the institutions to absorb. So the market created liquidity the only way it knows how. It crashed. The crash to $71 forced leveraged traders to sell. It triggered stop-loss orders sitting at $72 and $73. It created panic among retail investors who could not psychologically withstand the red numbers on their screens. These forced sellers became the liquidity that institutions needed. This is not conspiracy. This is market structure. The banks, the pension funds, the commodity trading advisors, they do not move markets through malice. They move markets through necessity. They need counterparties. And when counterparties are not voluntarily available, the market mechanism creates them through price action. The role of algorithmic trading in this dynamic cannot be overstated. Commodity trading advisors, known as CTAs, manage hundreds of billions of dollars using systematic momentum strategies. These algorithms do not think. They do not analyze fundamentals. They chase price. When silver fell through $75, the algorithms detected a momentum shift and began selling futures contracts. This selling accelerated the decline, creating a feedback loop. But the same mechanism works in reverse. When silver reclaimed $73 on Tuesday, the algorithms detected the momentum flip. Now they needed to buy back everything they had sold, plus establish new long positions for the upward trend. This double buying effect, covering shorts while opening longs, created the vertical green candle on the chart. The robots were chasing their own tails, and the price was the beneficiary. Understanding this dynamic reveals something important about modern markets. Price does not always reflect value. In the short term, price reflects positioning. It reflects the mechanical decisions of algorithms responding to other algorithms. It reflects the forced selling of leveraged traders hitting margin calls. It reflects the emotional capitulation of retail investors who cannot stomach the pain. Value remains constant through all of this. Samsung did not stop needing silver for its electronics. Solar panel manufacturers did not find a substitute material. The mines did not discover new deposits. Nothing about the fundamental supply and demand picture changed between Monday and Tuesday. Only the positioning changed. This is why professional traders often say that volatility is not risk. Volatility is opportunity. Risk is permanent capital loss. Selling at the bottom of a bear trap is permanent capital loss. Holding through it, or better yet buying into it, captures the spread between positioning-driven prices and fundamental value. The institutional calendar adds another layer to this story. December 31st is the most important date on Wall Street for reasons that have nothing to do with champagne. It is the day when fund performance is officially measured. Bonuses are calculated based on year-end valuations. Fee structures are determined by assets under management on December 31st. This creates a phenomenon called window dressing. Fund managers have an overwhelming incentive to push prices higher into year-end. If they are holding silver, they want silver to close the year at the highest possible price. Their compensation depends on it. The buying pressure we witnessed on December 30th was partly this window dressing in action. Institutions were not buying because they suddenly became bullish. They were buying because they needed the price higher for their annual reports. They were buying to erase the damage from Monday's crash before the books closed. This is legal manipulation. It happens every year, in every asset class, across every major market. It is baked into the structure of how professional money management works. Understanding this calendar gives you an edge that most retail investors lack. You can anticipate the buying pressure. You can position ahead of it. You can avoid being on the wrong side of the institutional incentive structure. The interplay between paper markets and physical markets reveals a layer of market dynamics that mainstream financial media rarely discusses. When silver crashed to $71 on Monday, something curious happened in the physical bullion market. Dealer premiums did not decrease, they increased. If you tried to buy American Silver Eagles or Canadian Maple Leafs at the spot price of $71, you would have paid $71 plus an elevated premium, sometimes 10 or 15% above spot. This disconnect tells you something important. The paper market, where futures contracts trade, can be pushed around by algorithms and liquidity events. The physical market, where actual metal changes hands, has a floor established by real supply and demand. During Monday's crash, industrial buyers stepped in aggressively at $72 and $73. These are not speculators. These are procurement managers at manufacturing companies who need silver for batteries, solar panels, and electronics. They do not care about technical analysis or moving averages. They care about securing supply for their production lines. These industrial buyers created a concrete floor under the paper market. They absorbed the selling pressure from the panicked retail traders and the mechanical algorithms. Eventually, the sellers ran out of paper contracts to dump. That is when the bounce began. This dynamic reveals a structural reality about the silver market that extends beyond any single trading day. We are in the 6th consecutive year of supply deficit. The Silver Institute's data shows that industrial demand exceeds mine supply by a significant margin annually. This deficit is cumulative. Each year it draws down the above-ground stockpiles that have accumulated over decades. The question is not whether silver will reprice higher. The question is when the stockpiles run low enough that price discovery truly begins. When there are no more old bars to melt, when the strategic reserves hit critical levels, the market will need to incentivize selling from sources that are currently unwilling to sell. That means jewelry. That means inherited silver sitting in safe deposit boxes. That means industrial users reducing their consumption. Incentivizing these sources to release metal requires prices substantially higher than current levels. The market mechanism knows this. That is why every dip gets bought aggressively. The smart money understands the trajectory, even if the timing remains uncertain. Gold provides the confirmation signal for this thesis. On Monday, gold crashed $150. On Tuesday, it stabilized at $4,373, up $46 from the low. Gold is the senior monetary metal. It is the fear gauge. When gold stabilizes, it signals that the liquidity event has passed and the underlying bid for hard assets remains intact. Silver is gold with leverage. It is the high beta play on the monetary thesis. It crashes harder during liquidity events and rallies faster during recoveries. Monday to Tuesday demonstrated this relationship perfectly. Gold moved 1%, silver moved 5%. If you can stomach the volatility in silver, you capture amplified returns compared to gold. But this leads to a deeper question that most investors never ask. Why does the relationship between paper prices and physical scarcity exist at all? Why can futures traders push the price of silver down on a day when industrial buyers are lining up to purchase physical metal at any price? The answer lies in the structure of the futures market itself. Futures contracts are derivatives. They are paper claims on metal that may or may not exist. The daily trading volume in silver futures far exceeds the available physical supply. Most contracts are settled in cash, not metal. This allows the paper market to diverge from physical reality for extended periods. But the divergence has limits. When industrial buyers stand for delivery, when they demand actual metal rather than cash settlement, the paper market must converge with physical reality. This is the mechanism that prevents permanent suppression. The paper market can manipulate prices temporarily. It cannot manufacture metal. The Commitment of Traders Report, a weekly disclosure of futures market positioning, shows that commercial banks remain net short silver. They have not fully covered their positions. They used Monday's crash to cover some contracts, but substantial short exposure remains. These banks are now facing a dilemma as the price rips higher. They can double down on their shorts, risking unlimited losses if the squeeze intensifies. Or they can capitulate and go long, which would accelerate the very rally they are positioned against. In 2019, a similar dynamic played out in the gold market. Commercial banks that had suppressed prices for years finally flipped from net short to net long. The price rose 50% over the following year. Silver watchers are monitoring for the same signal. If commercial positioning flips, it could mark the beginning of an unimpeded rally to levels that currently seem improbable. The corporate budget cycle adds another dimension that retail investors typically overlook. Large corporations operate on fiscal calendars. When January 1st arrives, new capital expenditure budgets become active. Procurement teams receive fresh allocations for raw materials. In December, these same companies were conserving cash to make quarterly numbers look favorable. They were running down inventory rather than restocking. This creates an artificial lull in demand during the final weeks of the year. In January, the dynamic reverses. Companies shift from destocking to restocking. They need to fill warehouses for spring production runs. This creates a structural wave of buying demand that hits the market precisely when the Ghost Week liquidity vacuum ends. The timing is particularly significant this year because the restocking demand is arriving into a market that is already tight. Imagine a crowd waiting for a restaurant to open. When the doors open, there are more hungry customers than available tables. A bidding war ensues. The corporations will compete for limited supply, and competition means higher prices. Currency dynamics amplify this effect. The euro has been weakening against the dollar. The Japanese yen has been weakening against the dollar. For investors in Germany and Japan, silver is already hitting all-time highs in their local currencies, even when the dollar price pulls back temporarily. This global demand creates a foundation under the dollar price. Silver is traded worldwide. You cannot suppress it in New York if it is breaking out in Tokyo. Arbitrage algorithms will equalize prices across markets. The global bid flows into the American market, supporting prices even when domestic sentiment wavers. The geopolitical hedge represents perhaps the most underappreciated factor in precious metals demand. As 2026 begins, the global landscape presents substantial uncertainty. Election cycles in major economies, ongoing conflicts in multiple regions, currency volatility as central banks navigate the aftermath of historic monetary expansion. Smart money does not want to enter a year of potential turbulence holding only paper assets. They want chaos insurance. Hard assets that cannot be printed, cannot be defaulted on, cannot be frozen by sanctions or seized by governments. Silver serves this function. It protects against war. It protects against currency failure. It protects against systemic banking disruptions. Buying silver at year-end is a rational response to geopolitical uncertainty, regardless of short-term price action. The fear trade is now layering on top of the industrial trade. Monetary demand from investors worried about the financial system. Industrial demand from manufacturers who need the metal for production. Speculative demand from traders riding the momentum. These overlapping sources of demand are all pulling in the same direction, while mine supply remains constrained. The events of the past 48 hours offer a template for navigating volatile markets more generally. The lessons extend beyond silver to any asset class where retail investors compete against institutional players. First, position sizing determines survival. If Monday's drop caused you genuine panic, your position was too large. The goal is to hold through volatility, not to white-knuckle through every correction. A position that keeps you awake at night is a position that will eventually lead to a mistake. You will sell the bottom or buy the top because emotional pressure overwhelms rational analysis. Second, time horizon determines perspective. On a 15-minute chart, Monday looked catastrophic. On a monthly chart, it barely registers as noise. The same price action appears completely different depending on the time frame you use to view it. Professional investors operate on time horizons that extend years and decades. Retail investors often operate on time horizons measured in hours and days. This mismatch in perspective systematically transfers wealth from retail to institutional players. Third, understanding market structure provides an edge. If you know that year-end window dressing creates buying pressure, you can anticipate it. If you understand that algorithmic momentum strategies create feedback loops, you can recognize when price moves are mechanical rather than fundamental. If you grasp the relationship between paper and physical markets, you can identify when short-term price action diverges from long-term reality. Fourth, emotional control is a form of alpha. Alpha is the financial term for returns above what the market offers. Most alpha is captured through information advantages or speed advantages. But emotional control represents a form of alpha that is available to anyone willing to cultivate it. The weak hands who sold Monday provided liquidity to the strong hands who held or bought. The emotional tax was transferred from the impatient to the patient. The market is designed to exhaust you. It wants you to give up. It wants you to conclude that the stress is not worth it. But the stress is precisely why the returns exist. Easy money attracts competition until the returns disappear. Hard money, money that requires psychological durability to capture, remains available to those willing to endure the discomfort. Technical analysis provides a framework for understanding where prices might move next, though it should always be held lightly. The pattern that just completed, a breakout followed by a sharp pullback followed by a recovery, traders call a slingshot. The pullback loaded the spring. The recovery released it. The mathematical target from this consolidation pattern suggests prices in the mid-80s by early first quarter. This aligns with Fibonacci extensions and previous resistance levels. The market appears to be searching for this zone, though the path will not be linear. The moving averages that were briefly violated on Monday have already been reclaimed. In technical parlance, a support level that is broken but immediately recovered is not a breakdown. It is a bear trap. The bears who shorted the breakdown are now underwater. As the price rises, they will need to cover their positions, which adds to buying pressure. The relative strength indicators that were approaching overbought territory have now cooled. This technical reset allows the trend to continue without the warning signs that often precede corrections. The steam escaped from the pressure cooker. Now the pressure can build again toward the next major target. But technical levels matter less than structural realities. The deficit between supply and demand is widening. The geopolitical landscape is unstable. The monetary environment favors hard assets. The industrial demand from electrification and renewable energy is secular, not cyclical. These factors will ultimately determine price trajectory over quarters and years, regardless of what happens on any given Tuesday. Markets have a way of revealing character. They test patience, they test conviction. They test the ability to distinguish signal from noise. Monday's crash was noise. The algorithmic cascade, the stop-loss hunting, the panic selling, none of it changed the fundamental reality of the silver market. The metal is still scarce. The demand is still growing. The deficits are still accumulating. But many investors will look back on Monday as the day they sold. They will calculate the gains they would have captured if they had held through the discomfort. They will join the long list of participants who learned the same lesson, the expensive way. The financial system is not built to reward the majority. It is built to transfer wealth from the impatient to the patient, from the emotional to the rational, from those who react to price action to those who understand what drives it. This does not require special information. It does not require insider connections. It requires only the willingness to see the market as it actually operates, rather than how it appears to operate. It requires understanding that volatility is the cost of admission, not a reason to exit. The trap that snapped shut on Monday caught many victims, but it also created many victors, those who recognized the pattern, held their positions, or accumulated at discounted prices. In the end, this was never really about silver at all. It was about the ongoing education that markets provide to anyone paying attention. The tuition is denominated in dollars lost or lessons learned. The choice between paying one or the other belongs entirely to the student. The year is ending. The positions are set. The next chapter begins in January. Those who understand how the system works will be ready for it. Those who do not will provide the liquidity.